what we're trying to do to the specifics of the perils. And that becomes even more critical when you know that countries are exposed to more than one set of risks and different types of hazards, particularly where you have varying vulnerabilities depending on the populations and their ability to be resilient to those. And so looking at it in the whole is very important. We know that there is, as we said, there's a need for immediate financial relief for large-scale catastrophic events. We also know that we need to take a long-term view, as I said. And there will be trade-offs. There's trade-offs in terms of cost, but there's also trade-offs in terms of what returns you can get from the types of activities you can do. And so we look not only for the obvious answers, we'll try and find creative answers to things. One of the areas that we've made a lot of effort over the years recently is in pooling of risk management. So this is looking, I think there was a couple mentioned here, the Pacific Islands, but there's also the Caribbean Islands Catastrophe Fund. We have a new one called SEADRIFT, which is Southeast Asia Disaster Risk and Insurance Funds. These are disbursement mechanisms that pool resources for multiple countries. This is a multinational approach. It looks at commonalities, but it also reflects the fact that countries can be different in their approaches too. But it's trying to make the most of leveraging both available resource in the countries, but also the leveraging of available capital and other things that are available from the markets as well. So this is a key area for us. It's trying to find creative ways of dealing with that risk. Just to say at the end of that I think, to answer the question again, it's effectively the toolbox approach for us. It really is a case of looking at what's needed from those who are the recipients, and working with governments particularly to find the most effective ways of doing that.
Great. Now, given the audience here, and just to kind of make it really as, if you like, applicable to the way that you look at this as possible, what kind of insurance products at the sovereign level, but also at the meso and micro level, is the World Bank sort of supporting? And can you give us some practical examples of how they work?
Absolutely. This is where what we're doing becomes real. I mentioned this toolbox. We look for layered structures. We know that there's not one answer, particularly when you look at risk. Risk for us, you can put it into the context of frequency and severity. You can have high frequency natural catastrophe risk. You can have things like floods that happen every 2 years, every 5 years, every 10 years. You can have very large earthquakes, which we've seen even in developed countries, in Southern California in the last few days. You can get large-scale events which are likely to be infrequent, but when they happen, can have significant impacts. So these things we have a whole range of things we have to deal with. So this layering approach, identifying the best mechanisms for particular needs around disbursement. For instance, you might, want for some things a contingency fund or a reserve fund might be the most appropriate way of dealing with it, because it's the most cost-effective way of dealing with very high-frequency losses. For instance, if you have multiple floods every year, insurance might not be the best approach for that. It may be not cost-effective or not even available in terms of insurance markets. We look for the most appropriate way to work with the private markets as well. So public-private sector relationships are important for us to find the most effective tools. And we will then look for, as I said, large-scale programs. We want to leverage and maximise the ability of our money that we have from our donors, particularly, and our partners, maximise what we can get from that with private funding as well. And so we have a number of index-type based approaches. We have a number of, as we saw, initiatives that try and pool risk to try and find the most cost-effective way of dealing with it. We'll use, mostly from the sovereign side, we'll use things like parametric tools, which we might go into as well, and other types of alternative risk transfer products, unlocking large-scale capital that doesn't necessarily exist in the traditional insurance markets. But then we might use traditional insurance as well, because it may be more effective, for instance, for certain public assets or infrastructure risks where they're more complex. One example I'd give of where we try and it's more to do with the scale of impact. So this is now looking at who actually receives the benefit. For instance, at community farmer level, which is a key area for us, obviously, then you can start to look at something like our global index insurance facility, which effectively gives disbursement of funds to farmers at community levels based on national scale parametrics. And so we can provide immediate disbursement of funds through this index simply as possible to those who need it as quickly as possible. And so we try and find the most effective tailored ways to provide that funding to those who need it at different levels. In terms of microfinance, that's not my personal area of work, but I know obviously that the bank is very closely aligned to working in those areas. Equally, the insurance market has a group called the Insurance Development Forum, which is a public-private sector partnership that includes the World Bank as well as a large number of the world's largest insurance and reinsurance companies. They have a very large microfinance and mutual insurance arm. So mutual insurance is a key part to this as well. The mutualisation of risk management is a key thing that the bank is keen to promote where it's effective, not only at sovereign level but at community levels as well.
I think you in the audience will have particularly paid attention to what Matt was saying about unlocking new sources of risk capital, because of course that's one of the major things that we want to demonstrate today in a sense, because this is an opportunity for Takaful. But just looking at the international donors and how they view disaster risk finance. I mean, traditionally, bilateral, multilateral agencies have been sort of at the forefront of that ex-post sort of response in many ways, right? Are we seeing a change in donor behavior there in terms of more resources going into disaster risk finance, and particularly also resources being made available in terms of risk capital?
Absolutely. I mean, I can answer that absolutely. You've only got to look at the importance being placed on disaster risk financing by both donors, and I can explain a little bit more some examples of that, but also at the major international economic forums. So the G20, the V20, one that's coming up soon, which is the APEC conferences in Chile. Disaster risk financing is top of the agenda and has been becoming more increasingly important in those areas, as it's recognised, very importantly, I have to stress, as one of the tools that is available to support longer term preparedness and financial resilience for countries. It goes back to my main area of interest in the bank, which is infrastructure. It's critical that we build better infrastructure to be more resilient as well as more sustainable, as we've seen this morning. That needs the right level of protection, and that protection has to come from financial risk transfer as much as it is physical. The two are aligned, actually, through things like risk engineering, which is another advantage of disaster risk financing because it provides more than just the capital. But the important thing is that these things are seen as critical strategic needs in every sense for countries to become more resilient and more able to withstand increasing frequencies and severities of shock events. The partnerships part is very clear. The donors that we operate with are increasingly keen that their funding is leveraged, that they get the most from that investment. And so, for instance, there are initiatives, again, through joint partnerships with the insurance markets. For instance, the Insure Resilience Partnership, which some may have seen. The Insure Resilience Partnership is a multiple entity partnership between donors, particularly the UK with VII, but also the German donor agencies, and the World Bank and others, to develop and leverage insurance funding as effectively as possible to key aspects of not just humanitarian disbursement at the point of event, but equally to increase the long-term sustainability of countries to be able to deal with those risks. There's a particular facility which is partly with that, which is called GRIF. This is the Global Risk Financing Facility. It's quite new, funded again by DFID and by the German agencies. And its aim is actually to bridge the gap between immediate humanitarian disbursement of funds post-event, which is still critical, as you said, to get people money and the ability to deal with things immediately. But it's also then to scale up the ability of funding to increase resilience around these types of perils. It's trying to build a balance, perhaps. That's probably the best way to deal between the two, with the main aim being increased preparedness. That really is its main aim. And this fund is now generating significant opportunities around different countries to add to and complement what's already there in certain other funding streams. And so it's really a complementary, almost turbocharging is the way I look at it in my simplistic mind, the way that we can then make most of the investment that we can get from donors. The donors will be always important, but it's not just national donors. Rockefeller, the Bill and Melinda Gates Foundation and other philanthropic agencies are equally important in these areas, and the Rockefeller particularly in the Seadrift programme that I mentioned in Southeast Asia are a key partner. And so it's really finding, again, the best partnerships to deal with the problems at hand. From my perspective, I'm very pleased to say that I am a Londoner. You can probably tell from my accent. I haven't moved very far, but I'm very lucky that, obviously, as you know, the bank is primarily in Washington, D.C. My team is primarily in Washington, D.C. I am based in London. The reason I'm based in London is partly because the insurance market that's in London is a key partner, but it's not just that. It means that I can get to places that people in DC would take a very long time to get to. And we're also able then to work in Africa and other areas more easily. Equally, it's a DFID-funded, a UK DFID-funded partnership. So our hub is funded by a single donor trust fund through Department for International Development. We work in the same office and very closely with a group that they have set up for the Centre for Disaster Protection, which is an equally funded part of that hub area. In the same office, we work very closely on projects where they can help effectively build much more capability, both in terms of the analytics and the knowledge transfer, but also then in the financial risk transfers as well. And so, again, it's an example of how donors are working very closely with the bank to find the most effective ways of using the resources that are available.
So we heard about the bank, okay, the World Bank. We heard about donors. Where does the private sector come in here, and what role is it envisaged to play in it?
Thanks. As you mentioned, most of my life has been spent in the private sector, and it is absolutely key. As we said, the bank has a large amount of resource. It has significant funds from donors and others. But I think we saw it there. You've already mentioned, Mohammed, it's a drop in the ocean, really, to the scale of the problem that we're trying to solve, which is growing and it's becoming more extreme. And so the private sector, whether that's the private sector for capital or it's the private sector for developing and investing in new infrastructure, is absolutely critical to what the bank and all the other agencies are trying to achieve. We have a particular... There's a thing about the bank that I still can't get my head around, which is this love of acronyms. Everything is an acronym. I can't begin to tell you. I have a list. I've been writing them down as I've been going through the bank. I've got a book full, and I haven't even started. But one of them is MFD, Maximising Finance for Development, which is one that I have got up here in my head at the moment. And that is effectively what we're trying to do. We're trying to maximise finance. Now, that means bringing the private sector in the most effective ways into that process. Mobilising capital, obviously, is a key thing. But it's not just about that. We go back to the other point, which is providing technical capability to those in those countries to deal with risks themselves as well, which is equally as important. So we have a lot of analytical and knowledge transfer activity that we also do under the funding model that we have, and we leverage private sector knowledge as much as we can into that area. An area that I'm working on, particularly at the moment, is in the infrastructure side and in construction risk. And it's trying to find ways of valuing risk effectively on standards. And so we're working with international standards agencies to find the most effective way, for instance, of providing countries with a way to estimate the value of risk, which is actually very difficult to do. How much does a bridge cost, for instance? It really is something that needs standards and technical ability to do consistently, because that's very important if you're trying to then leverage insurance, to know what the value is that you're trying to insure. So these are the key things that we're trying to develop. The capacity to deal with risk at the local domestic levels is absolutely critical, and we need the private sector. We also need it to make more efficient ways of dispersing risk. Insurance, for instance, has a real problem sometimes with dispersing payments. We can go on for hours about traditional insurance, how long it takes to get a claim through. Technology is absolutely critical. That's the other area that we're really keen on. It's the technological ability to improve and disrupt the way that we do things. And so there's a big area in London again, but it's more broad than that. On the insurance technology side, the insurtech side, the disruptive technologies, particularly around claims management and the ability to provide funding to local and household level policyholders, potentially, of the funding that they need and the disbursement of money when they need it as quickly as possible. So I think really it is this mobilisation. I'll go back to the Insurance Development Forum, which I mentioned briefly. Again, that's a great example. Working in partnership with the insurance markets, however they are formed, whether that's a Takaful type insurance arrangement where it's appropriate or a more traditional insurance arrangement, to provide the most leveraged ability to fund protection to those who need it. Particularly, though, and a major area that we do need to work on is improving the ability at the domestic level for those insurance markets to work effectively for themselves, provide the capital and the expertise for domestic markets.
Thanks, Matthew. I've just heard Matthew from the World Bank talk about Takaful. Just very briefly before Safder actually tells us a little bit more about the opportunities that he can sort of spot in what Matthew is saying. Very briefly, Matthew, what is the World Bank's sort of view on Takaful? We very briefly talked about this earlier on, but just to kind of, make sure that, there is an opportunity here, right? And it's maybe the hot topic of today somewhere in Washington or elsewhere.
Absolutely. It goes back to the main aim of the disaster risk financing function. We're looking for the most effective way to provide funds to those who need it. And we recognise very clearly that there is no single answer to that, culturally, financially, regulatory, governance-wise, just politically sometimes. It's a complicated world, and we need to work. You've already mentioned the scale of the need is absolutely critical. We need to be able to work effectively with those who can help. And Takaful provides a vast potential to do that. Now, the bank, I hope the fact I'm sitting up here is a physical evidence that the bank is obviously interested, more than interested in this dialogue and exploring this. But I know, even though I've not been at the bank as long, there have been significant discussions over the years around Takaful with the bank in different areas. Not so much on crisis risk or disaster risk, but certainly Takaful is an area that the bank is clearly interested in. And again, it goes back to the point of just how do you structure the most effective way to deal with these types of shock events and crises and develop countries' abilities and increase economic growth and reduce poverty. It goes back to the main goals of the bank. How do you do that? You do that aligned to the way that countries can deal with it themselves and provide those most efficient ways of dealing with it. And obviously Takaful, I'm learning a lot, particularly here today. Takaful does provide structures. It provides what we need. It's one of those structural mechanisms which allows people to have confidence in the ability to risk transfer in the most appropriate ways. And that has to be the major point. Everything has to be appropriate. So we have to look again, as I said, at what the need is first. What's the need of those who are ultimately receiving the support? How do you get a benefit to those communities and those countries? And so it's partly that, it's partly finding that, it's partly learning. Everything evolves as well, that's the other point. The world is dynamic. We're seeing that every day, not only in terms of physical risk, but just the way the world works. And, we need to be able to make the most of every opportunity and work with and partner those who can help our ultimate goals.
Great. I think we're nearly ready for Safder now to shed some light on the opportunities there for Takaful. Just very briefly, you mentioned early on the idea of this parametric insurance. Obviously, particularly for weather and climate-related events, the traditional kind of indemnity loss and damage sort of products have limitation to some extent, right? As we're trying to, we're trying to catch the damage as it gets greater, sort of before it really becomes massive. How does parametric or index-based insurance work, and what are the pros and cons in this, particularly sort of in that climate and weather disaster area?
Thanks. Yeah, obviously, it goes back to toolbox. We have traditional insurance. You have a policy, you pay a premium or whatever. That premium, that policy is an agreement, contractual agreement, to provide funds in the event of something bad happening that you can claim. So you claim, you receive the payment. That can work. I mean, it's great. It's very useful. But the problem is speed. As we've said, speed and transparency. You need funding immediately in many, many cases to get funding to people as quickly as possible, particularly if there is a time-critical need to make some sort of mitigation process, for instance, providing money to allow farmers to buy additional feedstock for their livestock because local vegetation isn't growing because of drought or other environmental factors. And so you need the ability to guarantee that fund can be made available within the timescale that's necessary. Immediate disbursement of funds, that's a major advantage of parametrics. Parametrics are basically, they get rid of all of the associated issues around claiming for a particular, or proving that there's been damage. There's no need for that. A parametric is effectively a trigger. It will allow money to move from one place to another almost instantaneously once that trigger has been met. And that trigger could be based, for instance, on rainfall.